Utilities tend to make excellent income stocks. That's because these companies generate relatively consistent earnings by supplying electricity and natural gas to consumers. With little need for that cash flow, they can return the bulk of it to investors. As a result, most utilities pay an above average dividend. While there are dozens of publicly traded utilities in the U.S. to choose from, the four largest by market cap are NextEra Energy, Duke Energy, Southern Company, and Dominion Energy. Given their large-scale operations, these companies have a lower risk profile than smaller utilities, which is why it makes sense to focus our attention on these four main players to find the best dividend stock in the sector. So let's take a look. Despite their large size, all four of these companies expect to grow their earnings and dividends at or above the industry average of 5% annually over the next several years. As the upper chart shows, Dominion offers investors the fastest growing dividend, which at a 10% annual clip through 2020 is nearly double the pace of Duke and Southern Company. To put that faster growth rate into perspective, here's what these stocks would yield in 2020 if they met the midpoint of their dividend growth expectations. So looking at the lower chart there, the lower chart shows that Dominion's faster growing payout would enable investors who buy today to collect a 5.4% yield on that investment in 2020, which would be higher than all but Southern Company. While that might make it seem like Southern Company is a better dividend stock, the yield is only part of the question. Go ahead and freeze your video to take in all of this information, and then we'll move on. All too often, dividend-focused investors only seem to care about a stock's current yield. However, that payout only supplies a portion of their total return on investment. More often than not, a greater percentage of an investor's return comes from an increase in the company's value due to earnings growth, with stocks tending to rise alongside those rise in earnings. This factor is where Dominion rises above the competition since it expects to grow earnings at more than 8% annual clip through 2020, which leads its peer group. One of the drivers of that forecast is the company's recently announced plans to acquire rival utility SCANA Corporation. That deal, if completed, would increase Dominion's earnings growth rate from its current forecast of 6 to 8% annually through 2020 up to more than 8% per year over that time frame. Driving that acceleration is the fact that Dominion is buying SCANA for a low price due to that utility's recent struggles, which will enable the transaction to boost Dominion's bottom line immediately. That higher end growth rate, however, should help Dominion generate higher total returns for investors over the next few years. For example, by adding the dividend yield to its earnings growth rate, Dominion would produce a 12% total annual return. For comparison's sake, the total return potential of both Duke and NextEra Energy would be in the range of 8% to 10% annually, while Southern's would be about 10% annually. Let's go to the charts. While Dominion doesn't offer investors the highest dividend yield in its peer group, it still has the best dividend overall. That's because the company expects to increase that payout and grow its earnings by peer-leading rates through 2020. That faster growing income stream increases the odds that Dominion can generate returns that should beat both its peer group and the market in the coming years, making it the top option in the sector to consider owning for the long haul. In this chart here is the 20-year monthly chart on Dominion Energy, and the symbol is D. And for disclosure purposes, I do not hold any position in Dominion Energy at this time. And looking at the chart, we can see that recently the price did move through both the 20 and 50 EMA for the first time since back here at the end of the Great Financial Crisis in 2009. Moving down into the MACD, we can see that the MACD was moving sideways, and then recently the fast line pushed down below the trigger line in late January, early February. We can see that as well here in the histogram, and in the momentum, things are still moving to the south, as well as in the price rate of change, and through here to the RSI. We're at 3166 there, and the stochastics still also moving down, as well as the Williams you can see here. Back up to the price chart. We can see that this is a relatively favorable position for the stock price, being below the 50 and the 20 EMA for the first time in several years. However, I think the oscillators are telling us that we just need to be patient here for the next few months before we take any position in Dominion Energy. And as usual, please conduct full, thorough analysis of the fundamentals and of the technical indicators. But for today, that's ChewDog Charts. Thank you.